bigger isn't necessarily better when it comes to tidal waves of taxes. And when we go to invest, do we think about the financial ramifications that taxes could potentially affect when it comes to investing? Not likely. What we usually worry about is what is our return, but we don't think about the tax impact typically. And when we invest in all of these tax deferred types of savings, for our future, we could probably get a really big spanking from the IRS, and that's what today's guest is going to talk about, because Phil Putney started his career in the field of public accounting by passing the CPA exam, first shot out, by the way, in 1990, which is always a tough deal. After obtaining the experience and requirements working for a large CPA firm in Bingham Farms, Michigan, Phil was awarded his CPA certificate in 91. He started his own practice, Putney & Associates, in Livonia, Michigan, working with closely held businesses and their owners, concentrating on effectively managing their tax burden. At the request of his clients, Phil became a registered representative and started offering financial services. And after offering both accounting and financial services to his clients for more than 10 years, he decided to focus on the financial services portion and transition full-time, and has been advising people since 2008. His background allows him to provide his clients a more complete financial planning strategy, because he can assist them in planning for their financial future as well as minimizing their potential tax exposure. And he joins us on today's show to help us figure out how to dodge that tax tidal wave. Welcome to the show, Phil. It's so great to have you a part of Unlock Your Wealth Radio.
Great. Thanks for having me. I appreciate it.
So one of the things that we don't think about when it comes to investing is tax liabilities. We think about, okay, what's my risk tolerance, or what are my returns going to be, or what's hot or not in the market. But yet you've got something you refer to as the tax tidal wave, and this can totally wallop us and blindside us if we're not prepared. Share with us what you refer to as the tax tidal wave.
Yeah, I'm glad you mentioned that, because I think taxes are actually one of the areas of investing that are often overlooked. Tax tidal wave is simply, once you're hitting retirement, your taxes sometimes can increase as much as 200 to 300% once you get into retirement in the right scenario.
Now, so how is that?
It's a prize when you get into retirement and you can't afford it. Well, great example from a client I just worked with. Thought they had done a phenomenal job saving for retirement, and they had, from all intents and purposes, had saved a significant amount in their retirement accounts, had money that they didn't need to touch those until they were at least 70. We're going to delay Social Security until age 70 to let it grow, so it looks like they were doing everything the right way, but they'd never looked at the tax side of it. And once we had done a projection to show them what would happen once they hit age 70 and a half, that's the magical years that IRS starts forcing money out of your IRAs with the required minimum distributions. You've maximized your Social Security. You've got the best benefit from Social Security, which is great. And now you have all this extra income coming in that you may or may not need, but it causes a significant increase in tax.
So, is there anything that we can do about it?
Oh, absolutely. Yeah, it starts with, really understanding what the problem is, or why is this the case. And it all comes down to having been taught, throughout our investment careers, that tax deferral is a great thing. You never want to pay for something today that you can put off down the road. And it does have benefits, but a lot of times is overused. In fact, the IRS even encourages it. They're giving you a tax deduction for it. They're hoping to reduce your taxable wages for 401k contributions, or they're making an IRA contribution, you're getting a deduction there. CPAs, tax preparers, they're using it as a tool to help reduce your current liability. And since, they're getting judged on how well they're doing based on the taxes that you pay, it helps them keep the liability down and makes them look good. In fact, I'm a CPA as my background, been a CPA for 25 years. I say I'm a recovering CPA.
Yeah.
And
I would have never guessed that there was an incentive for tax preparers to maximize the amount of savings, regardless of what the implications are later on down the road. That would have never occurred to me.
Sure. Well, tax preparers and CPAs, they're trained to be somewhat nearsighted. They're looking at last year, this year, and maybe next year. They're not really looking 10, 20, 30 years possibly into retirement. It's just not, part of how they view saving for retirement.
Right, because something that, I would probably gladly pay a few hundred or maybe a few $1,000s in taxes now versus tens of thousands later on down the road when I'm supposed to be enjoying myself. That doesn't make any sense.
Right. Yeah, and people are often too nearsighted. They're looking at just what it is today. Another mistake, I think, is people assume you're going to be in a lower tax bracket when you retire. And a lot of time I've seen that that's really not the case.
And is it because of these minimum distributions? Is that why?
Well, it could be minimum distributions or increasing their income, but the reality is your income, your gross income might be reduced. You don't need quite as much to live on, but you've also lost a significant amount of deductions. Hopefully by then your home is paid off, so you no longer have the mortgage deduction. Your kids probably aren't living with you anymore. They're not dependents, at least, so you're not getting a tax deduction for them. So you're losing two of the largest deductions that you've had. So your gross income might go down, but not necessarily your taxable income.
Okay. So how would what are some of the questions you would ask your financial planner to share or to help you discover what questions you need to be asking your tax preparer? Or do you want to get those two people to start working together? I guess what's the solution to this, or where do we start?
Well, you need to either have them work together, and it doesn't happen often. I mean, again, I can tell you in my career as a CPA, I never had a client come back to me and say, my financial advisor said I needed to run this by you. So it's probably not going to happen. The CPAs are going to want to bill you for the time. That's how they get paid. So more than likely, clients aren't going to want to do that. The best scenario is to work with an advisor that's been trained in the tax aspect of investing as well. So they have, either a tax background or they've taken additional training to truly understand that. And they're doing projections looking forward on your scenario, just with some simple assumptions, and how things are going to look from a tax aspect. But make sure that they are looking at taxes, because often they're not.
Okay. And so now, do we look at this from not just our IRAs, but we also want to think in terms of any 401ks or other type of retirement or tax-deferred investment vehicles?
Correct. Yeah, the biggest liability that you'll see is from those deferred investment vehicles, because they've grown for how many ever years you've been investing, completely tax-deferred. You've never paid tax on any of the money in them. So not only the contributions that you put in, they're going to be taxable when they come out, but 100% of that growth. So I tell clients you need to look at that account as having a tax mortgage on it, so to speak. Not 100% of your IRA or your 401k is really yours. It's yours and the IRS's.
Don't say that, la, la, la. I don't want to hear that.
I know. People don't like to think of it. That's why another reason that people like to defer their taxes. They, don't want to pay their taxes to the IRS any sooner than you have to. But you have to come to the realization that you're going to pay the taxes at some point. It's a matter of time, and when you want to pay them. Yeah.
Pay me now, pay me later. One of those two is going to happen.
That's right. You're going to pay at some point, now or later, and the choice is yours. A lot of people don't really realize they can do that they have a choice, but you will pay taxes at some point on that money. And if you've waited long enough at 70 and a half, you've now lost control of your IRA, and the IRS is now dictating to you how much is coming out of that IRA every year, and it's going to be taxable. Whether you need the money or not doesn't matter. It now has to come out of the account.
Okay, well, when we get back from the break, I want to ask you some questions about strategies we can deploy today to start preparing for the tax tidal wave so we can either surf and ride it or duck it completely. You are listening to Unlock Your Wealth Radio, and we'll be right back with more after this.
Commander Marty Logan here from the Top Gun Seminars. What I've learned over the years is that the most successful people in life have coaches to guide them along their chosen path. Wayne Gretzky, Michael Jordan, Tony Stewart, Tom Hopkins, Kathy Colby all had coaches. Whether it was their father, someone else's father, or another person who helped them to shape their desires into an achievable path to success with a system of accountability where quitting was the only way to fail. Each of these people had someone who didn't see them as they first were, but as the person inside they knew they could easily become. Financial coaching can be the single addition you need to become financially independent. Call the Unlock Your Wealth Foundation now for your free consultation. 1-866-966-9420. That toll-free number again is 1-866-966-9420. Or visit us on the web at www.unlockyourwealth.com.
Welcome to the Unlock Your Wealth Update. Here's Heather Wagenhals.
This week's moneyism is it takes money to make money. This is one of the most discouraging and negative moneyisms we teach our children, and this one remains with us into adulthood. Learning this destroys our confidence in ourselves and our capabilities. It also closes off our creative flow and resourcefulness. Some things do take money to start. However, until you explore what is really needed, you will never know if you can afford it or not. And on the outside chance your idea requires a huge sum of money and you are unable to fund it yourself, if your idea for a product or service has merit and you are able to convince others, people will invest in your idea. So instead of resigning yourself to a life of poverty because your wallet is light these days, instead of saying it's impossible, put your selling shoes on and say to yourself, I'm possible. For more great resources to help you create unlimited wealth and happiness, visit our website at crackingyourmoneycode.com. I'm Heather Wagenhals. Now go out and unlock your wealth today. Heather Wagenhals here from crackingyourmoneycode.com. Tune in to my Unlock Your Wealth update for your daily cup of money motivation. Weekdays at 12:25 during the midday news report on Corey's Hometown Radio, 1370 AM WWCB.
Attention passengers, please fasten your seatbelts as we are in for some turbulent weather ahead.
Bill Thomason is the Valley's premier business coach. Bill can help you ride out the turbulence your business may encounter. Bill Thomason is the America's premier executive coach and strategist. Bill can help you create the life you will love living. Over more than a quarter century, Bill has helped thousands of people just like you to achieve success beyond what they had imagined. Now is the best time you will ever have to decide what you want and to take powerful action toward achieving the outcomes you desire in your life. Bill has studied the success patterns of the highly successful people, and he has provided coaching and training programs to small business people and to top Fortune 500 executives across the U.S. and Canada. Now you can benefit from Bill's experience. If you are like most people, you may just need the professional encouragement a coach can give and a real plan for creating the outcomes you say you want in life. Call Bill now, 602-321-7192 to schedule executive coaching sessions.
Thank you for flying NLP Skills Training Institute.
Welcome back to the show, everyone. You are listening to Unlock Your Wealth Radio, and I am your purveyor of prosperity, Heather Wagenhals, and I am joined by the man who is going to help us defer the tax tidal wave, Phil Putney. And Phil, before the break, we were talking in terms of these, the IRS dictating to us what's going to happen if we wait until 70 and a half to start creating some of our strategies. What are some steps that we can start taking today before retirement to prepare to either minimize or totally duck this tax tidal wave? Is ducking possible?
Well, it's not entirely possible. The bottom line is at some point you're going to have to pay the taxes. But it's really up to you. You know, we work with our clients at AFS Wealth Management and coming up with their exit strategy, so to speak. You know, what is your overall plan for getting out of these retirement accounts that you saved up for all your life? It's rather easy to save for them, the strategies that you contribute through a 401k or an IRA, but once you start pulling money out, you need a strategy on that end as well, and what's the best way to pull the money out.
Okay. So when do we determine whether we go with, say, a Roth IRA and pay the taxes up front, or a traditional IRA where we defer that? When is that decision made? Early on, or do we do both?
Well, you bring up a great point. You do look at it early on, so you need to really kind of look forward and see what you think your tax liability is going to be based on the income level that you're going to need in retirement. But it's not a bad idea to do both. We often think of in investing, having diversification in your portfolio is going to help limit or reduce some of the volatility and the risk that you have in the portfolio. But there's another aspect of diversification that we work with our clients at on AFS Wealth Management, and that's called tax diversification. People don't hear that often or even think of it, but there are three types of accounts from a tax aspect that you can have. One is that taxable account or non-qualified account. A brokerage account is you put after-tax money in and it grows at a taxable rate. Any interest and dividend are taxable along the way. Tax-deferred or qualified accounts, your IRAs and 401ks. The money you put in has never been taxed and all the growth is deferred, so that has that liability. It's tax-infested, so to speak, and is going to have to be taxed in the future. And then a tax-advantaged account is like the Roth IRA you mentioned. So it's after-tax money in. Now the growth is tax-deferred, potentially tax-free if you follow the rules.
So when we talk about paying the taxes on some of these qualified accounts, is it taxed as ordinary income, or do we have the contribution of ordinary income and capital gains?
No, all your qualified accounts are going to come out as ordinary income.
Okay, so is that a bad thing or a good thing?
From a tax aspect, it's a bad thing. You don't have any breaks, so to speak. Capital gains, you're going to have a potentially lower tax rate, maybe even zero if you're in the right tax bracket. But from your qualified accounts, your deferred accounts, it's all ordinary income. So it can go as high as the top bracket.
Okay, so can you give me an example of a strategy that someone can do? Maybe is it layering these accounts?
Right.
What's kind of how you want to do it?
Well, it's a matter of, first of all, and I recommend clients have money in each one of these type of accounts. That way you can control your tax liability. One great example that I run into with clients, especially if they have all their money in a deferred account, is, you say you made it to retirement, now you want to take a big vacation. It's going to cost you $15,000. Well, if all your money is in a IRA account, you're going to have to take out 20, 25, maybe 30 if you're in a higher bracket to end up with that $15,000 net in your pocket. So if you have something in each one of these accounts, you can control that liability by maybe pulling it out of that taxable account where you've already paid taxes on the basis, or maybe it comes out of the Roth account. Yeah. So have some allocation between them.
Yeah, the thing that makes me so upset, or at least in the thinking, is that my lifestyle is going to somehow decrease. When I'm in retirement and I have the time, I want my lifestyle to go up, not down. So.
Right. Yeah, so back to my point of most people's tax liability really in retirement or their income isn't going to go down because, like you, they don't want their standard of living to decrease. They've saved for this great retirement they've envisioned, and hopefully that's the case. And it's going to go up, so they're going to need more income. Possibly taxes are going up.
Yeah, I'm ready to party like every day, play golf, travel. I'm so there in a bag of chips. Right, Michael?
Yeah, I mean, we can talk about this, but as you get older, your expectations probably get a little lower.
Not mine. Mine are just getting higher every day.
I mean, if you're talking about your 50s, that's different. But if you're 70s, you might want to travel less.
Right.
I don't know.
Yeah, and you go through different stages in retirement typically. You early retirement, that's when you do a lot of the travel that we see at least. You've saved for retirement for all these years and you're going to take those trips or do more activities. You're going to get into the slower years where now maybe your health isn't quite as good as it used to be. You can't do as much travel. So you're going to slow down a little bit. And then the latter part of retirement, though, picks up again from an expense standpoint, typically because of medical expenses.
Yeah.
That's another area where having this diversification can help, because you can pull some of those expenses out of a tax-deferred account or a tax-free account.
To cover medical?
Yep. Yeah, well, it's the same thing. It's an expense that you're going to have to pull from somewhere. So if you pull it out of a tax-free or tax-deferred account, you're going to have different liabilities. So it comes down to where you pull the money from to be able to control that liability. Because even though there is a deduction for medical, it's not for that first 10%. So you still have a big chunk of expenses that you're not able to deduct.
Yeah. So, Michael, since you're closer to retirement than I am,
take over the interview?
Yeah, I think you should start asking questions, because I'm not ready to retire yet. I got another 25, 30 years of working.
Yeah, I'm not sure what to say. I mean, I'm doing the best I can to, being a self-employed musician, I put as much as I could away, but I'm really counting on Uncle Sam to come through with Social Security and Medicare and all that stuff. So,
Yep. Well, and that comes through with, I mentioned having your plan. So you need to have what plan you're going to have for retirement. You're looking at income. There's three aspects to any retirement independence plan, we call it, at AFS Wealth Management. And that's an income plan. First is, what income do we need and where's it going to come from? Social Security, have a pension, and then you have to have an advanced tax plan. You have to look at taxes. IRSs, they have a plan for you if you don't have your own. So it's up to you which one you want to follow.
Yeah,
and then the last one is really that investment plan. Yeah, well, they do. Yeah, we call it the government default plan. So if you don't have a plan, that's the one you're going to follow. And you don't want that one. You'd rather have your own. So.
No. Well, if listeners want to avoid the government default plan and folks wanted to get a hold of you to find out more about what they can do to avoid the impact of the tax tidal wave, how do folks get a hold of you, Phil?
Well, they can find me at my website at www.afswealthmgt.com. My email address is pputney@afswealthmgt.com, or they can reach me at 248-888-7530.
Outstanding. Well, thank you so much for being a part of our show today. And for those of you who are driving around without a pencil, never fear. UnlockYourWealthRadio.com is here, where you can visit Phil's show page, get his phone number, email, website, and so much more. Stay tuned for more Unlock Your Wealth Radio. We'll be right back with more after this.